This video is on Chapter 22, how to complete some of your exercises using the alternate exercises. Chapter 22 is on performance, measurement, and responsibility accounting. The first exercise is 22.3, where we are going to allocate cost between different departments. This company has two service departments, office and purchasing, and they have three operating departments, which are books, magazines, and newspapers. The expenses of the service departments will be allocated to these three operating departments. The office expenses will be allocated based on sales, and the purchasing department, their costs will be allocated based on purchase orders. So we have the information for sales here for each of the operating departments and the information for the purchase orders in this column. The office has a total of $10,000 that we need to allocate to the three departments, and the purchasing department has $15,000 that we need to allocate. First, we're looking at office. So this $10,000, they're based on sales. All we have to do is list the sales for each department here, get the total, and then divide each department by the total so we can get the percentages, and make sure that the percentage is equal to 100%. Then we just multiply each one's percentage times the total cost of $10,000. And when you're finished, also make sure that the total allocated equals the cost that you're allocating. Purchasing is based on purchase orders, so we're going to list each department's purchase orders here. Then we'll take each percentage divided by 2,000 and then get a percentage. Make sure, again, the percentage is equal 100%. And the purchasing department has $15,000 in costs to be allocated. And just like before, make sure that the total allocated cost equal the amount that you're allocating. This is exercise 22.4. This person, Mia, works in two different departments, and we want to allocate her salary between these two different departments, jewelry and cosmetics. Mia earns $1,125 for 2 weeks, and so we want to allocate it between jewelry and cosmetics. So for jewelry, she worked 34 hours plus 11, so that comes to 45. Cosmetics, 23 plus 7, which comes to 30. So this total is 75. We're splitting between jewelry and cosmetics. Then we get the ratio, just like we did in the previous exercise. Make sure that the totals come to 100%, and then we'll multiply by her wages of $1,125. And then again, make sure that the allocation for each department comes to the amount that we allocated. This is alternate exercise 22.8. We want to prepare a departmental income statement for the ski department. They have sales of $650, cost of $450, direct expenses, salaries and depreciation. Rent is an indirect expense, and this is their portion of the service department's expenses that would be allocated to the ski department. The ski department is an operating department, and the service department is a service. So their expenses are allocated to the operating departments. List the sales, subtract the cost of goods sold to get gross profit. Now we're just going to list each of their expenses: salaries, rent, depreciation, and their share of the service department. Their total expenses are $205. Gross profit is only $200, so they have a loss here. But what if we only look at their direct expenses? So again, list revenue minus their cost, get gross profit, and now we're looking at their salaries and depreciation. These are the two direct expenses. If we subtract that from the gross profit, we get departmental contribution to overhead. So we don't want to eliminate this department because they are contributing to the overhead. Because if you just look at the direct expenses, they are covering more than their direct expenses. This is alternate exercise 2210. We want to compute the return on investment, which is computed as income divided by average assets. Electronics income is $550 divided by their average assets of $5 million. Their return on investment is 11%. Sporting goods, their income is $360 divided by the $4.5 million. Their return on investment is only 8%. So if they were choosing between these two, they would obviously choose the electronics. Now we want to assume that they will earn a target income of 6% of their average investment. In part 2, we want to assume that they will earn a target income of 6% of their average assets, so 6% of these amounts. Their actual income is $550 for electronics. Average assets times 6%. So their target income is $300,000. So electronics is doing pretty well here. They have earned more than this target income of 6% of their average assets. What about sporting goods? Their actual income is $360, and their target, based on this scenario, is $270. So they also are earning more than this target income of 6% of their average assets. But electronics is still doing better than sporting goods. The last assumption is that the Electronics Center is presented with a new investment opportunity that will yield 9%. Should they accept it? So yes, they should accept it because 9% is greater than 6%. And we already know they're earning more than 6% right here. So yes, they should accept the new opportunity. Your last question in Chapter 22 is a Tableau question on allocating indirect expenses. So you will be presented with those graphs and you will complete exercises similar to what you did in the exercises, except you'll be using the graph information to determine the answers. This completes the video on your Chapter 22 alternate exercises.